When most people hear real estate investing, they picture putting down a $50,000 down payment on a rental property, dealing with tenants, and handling maintenance calls at 2 a.m. And for a lot of people, especially younger investors just getting started, that's completely out of reach. But here's what most people don't realize: you can get exposure to real estate with less than $1,000, and in some cases, less than $10. No mortgage, no tenants, no property management. In this video, I'm going to walk you through 5 legitimate ways to invest in real estate with under $1,000, what they are, how they work, the risks, and who each one is best for. Option 1: REITs, Real Estate Investment Trusts. This is the most accessible way to invest in real estate, and you can start with as little as $1 if you use a fractional shares platform. A REIT is basically a company that owns income-producing real estate, office buildings, apartment complexes, shopping centers, warehouses, hospitals, data centers. By law, REITs must distribute at least 90% of their taxable income to shareholders as dividends. This means you get regular dividend payments just for owning shares, similar to how you'd earn rental income from a physical property, but without any of the management headaches. You can buy REITs through any brokerage account, Fidelity, Schwab, Robinhood, the same way you'd buy a stock or ETF. There are publicly traded REITs that trade on the stock exchange, and there are non-traded REITs that are less liquid. For most beginners, publicly traded REITs are the way to go. Some popular options include Realty Income, ticker O, which has paid monthly dividends for over 50 years, Public Storage, PSA, which owns self-storage facilities, and Prologis, PLD, the largest industrial REIT in the world. You can also buy REIT ETFs, like the Vanguard Real Estate ETF, VNQ, which gives you diversified exposure to dozens of REITs in a single fund. With $500 or $1,000, you could build a genuinely diversified real estate position across different property types and geographies. Dividends typically range from 3 to 6% annually, and you also benefit from any appreciation in the underlying real estate value. Option 2: Real estate crowdfunding platforms. These platforms pool money from multiple investors to fund real estate projects, residential developments, commercial properties, renovation projects. You put in $500, someone else puts in $500, and together with hundreds of other investors, you're collectively funding a real estate deal. Platforms like Fundrise, RealtyMogul, and Arrived Homes have lowered the barrier significantly. Fundrise, for example, lets you start with just $10. You invest in a diversified portfolio of properties and earn returns from both rental income and property appreciation. Historical returns on Fundrise have ranged from around 5 to 22% annually, depending on the year, though past performance doesn't guarantee future results. The main trade-off versus REITs, crowdfunding investments are less liquid. Your money may be tied up for 3 to 5 years, depending on the platform and project type. Option 3: Arrived Homes, and similar platforms for single-family rentals. Arrived lets you buy fractional shares of individual rental homes starting at $100 per share. You literally co-own a real house with other investors. The platform handles everything: finding the property, vetting tenants, handling maintenance. You receive your proportional share of rental income quarterly and participate in any gains when the property is eventually sold. This is as close as you can get to owning a rental property without actually owning one. The minimum is just $100 per property. With $1,000, you could invest across 10 different homes in different markets, spreading your risk across geography and property type. Returns vary by property, but rental yields typically range from 3 to 7% annually. Option 4: Real estate debt investing. Instead of owning equity in a property, you can lend money to real estate developers and earn interest, essentially acting as a bank. Platforms like Groundfloor let you invest in short-term real estate loans for as little as $10. These are typically fix and flip projects. A developer borrows money to buy and renovate a house, then sells it and repays the loan with interest. Groundfloor advertises average returns around 10% annually, though individual loans carry risk. If a developer defaults, you could lose principal. To manage this risk, diversify across many small loans rather than putting all your money into one. With $1,000, you could spread across 50 to 100 different loans at $10 to $20 each, which significantly reduces the impact of any single default. Option 5. Real estate adjacent investments. If you want indirect exposure without directly investing in property, consider Homebuilder stocks or ETFs that focus on real estate services. Companies like D.R. Horton, Lennar, and NVR profit directly from real estate demand even though they're not landlords. The iShares U.S. Home Construction ETF, ITB, gives you diversified exposure to homebuilders and building materials companies. This isn't pure real estate investing, but it's a way to benefit from real estate market growth without the illiquidity of direct property ownership. You can buy these through any standard brokerage with any amount. Now let me talk about the risks, because no investment is without them. REITs can decline in value, particularly when interest rates rise, because higher rates make bonds more competitive and can pressure REIT prices. Crowdfunding investments are illiquid, meaning you can't easily sell if you need the money. Individual real estate loans carry credit risk. And all real estate is subject to local market conditions, vacancy rates, and economic cycles. That said, the diversification benefits of adding real estate to a portfolio are well documented. Real estate historically has low correlation with stocks, meaning it can hold value or even appreciate when stocks decline. This makes it a useful component of a diversified investment portfolio. How should you think about allocating under $1,000 to real estate? Here's a simple framework. If you want the most liquid, most diversified option, put $500 into a REIT ETF like VNQ through a standard brokerage. If you want passive income with slightly higher yields, split $500 between Fundrise and Arrived for diversified rental income. If you're comfortable with more risk for higher potential returns, allocate $200 to $300 toward a debt investing platform like Groundfloor, spread across at least 20 individual loans. These can all be combined, and none of them require active management, property searches, or tenant screening. A quick note on taxes: REIT dividends are typically taxed as ordinary income, not at the lower qualified dividend rate. This is something to be aware of, especially in taxable accounts. If you have access to a Roth IRA or HSA, holding REITs inside those accounts means your dividends grow completely tax-free, a significant advantage over time. Many experienced investors hold their REIT positions in tax-advantaged accounts specifically for this reason. To wrap up, real estate is no longer reserved for people with significant capital or an appetite for being a landlord. With REITs, crowdfunding platforms, fractional rental shares, and real estate debt investing, you can start building real estate exposure today with $10, $100, or $500. The best investment is the one you actually start, even if it's small. As your income grows, you can increase your real estate allocation and eventually graduate to direct ownership if that aligns with your goals. But there's no reason to wait until you can afford a down payment. The time to start is now. Subscribe for more practical investing content, and I'll see you next week.